All right, well, we are delighted to have Hanno Lustig from right here at Stanford talking with a great title, What About Japan? And so take it away, Hanno. So do you want, sometimes people speak uninterrupted for 45 minutes and then the other, but you're an economist, so can we interrupt all the time?
Please.
Okay.
Yes,
good.
I think that's gonna work better. Okay, well, thanks so much for giving me this opportunity. Really excited to get to talk to you about this paper we have. What about Japan? This is joint work with Yili Chen, who's at the St. Louis Fed, and Hal Cole, who's at UPenn. And in a way, this is actually a UCLA product because we were all at UCLA when we met each other. Yili was a student of Hal and mine. And you mentioned the title, so let me actually tell you how we ended up with this title. When I started working on fiscal sustainability, probably 6 or 7 years ago, and I started giving seminars, there would always be one person in the seminar room. You could set your clock to it, who would raise his or her hand and say, well, what about Japan? And
I know I've been getting that question every year since about 2005.
You must have been getting that question.
Every
Right.
fiscal theory seminar, someone thinks this is a brilliant new observation.
Yes, and it was a bit frustrating because I didn't really have a good answer because I didn't know anything about Japan. And so then I decided together with Hal and Yili to actually dig into what's going on in Japan and try to make sense of.
Have you lived in Japan?
I have been to Japan once. In fact, I went there to give this paper, and I can tell you later what they told me about the paper. I got some feedback on it, but so that's essentially the sort of the genesis of the paper, is trying to address that question, because whenever you talk about fiscal sustainability, people like to come up with sort of a counter example, suggesting that maybe we shouldn't be too worried about the government's intertemporal budget constraint. And so what we realized from looking at Japan is that it's certainly not the right lesson. Okay, so what I want to do first is sort of talk a little bit about debt dynamics. First, for just the central government in Japan, I'm going to try and convince you that that's not the right way of looking at it. And then I'm going to think about the entire public sector, where we consolidate the central government with the central bank and pension funds and publicly owned financial institutions. And then we're going to actually make progress on what's going on. Just to set the stage for the discussion, let me remind you why Japan has been running large deficits. This is probably not news for anyone here, but Japan is at the leading edge of this demographic transition that most advanced economies are undergoing. As you know, fertility rates have dropped tremendously around the world, whereas at the same time, life expectancy is going up. And that puts a lot of pressure on the budgets of governments, especially in countries where there's a pay-as-you-go or unfunded pension system. And so over the past 20 years, Japan's Social Security payments have increased from 17 to 35% of the government's budget. So that's the main source of these deficits. The Japanese government has made generous promises to older Japanese people, and they're struggling to keep those promises. So as a result of that, Japan's government is running large deficits, primary deficits of around 5% per annum. Between 1997 and 2023. I'll show you that in a second. And as a result of that, it has one of the highest debt to GDP ratios in the world. But so far without a fiscal crisis. And so then the question is how, why? And I'll start off by saying the answer is not that Japan is sort of applying some of the R lower than G magic. It's not in that sort of Goldilocks region of the parameter space. So that is not what's going on. Why is it interesting for all of us to study Japan? Well, I think it's interesting because of what I said. They're at the leading edge of this demographic transition. And it looks like certainly other advanced economies are going to deal with or are already dealing with similar challenges. Certainly in Europe, US is a little bit behind in terms of the demographics, but it looks like we might be on a similar trajectory. So studying Japan is kind of interesting because in a way they've been running an experiment for us, and I think it's kind of important to try and see if we can understand what happened there. So,
Hanno, can I ask?
yes.
How much of the debt is due to they're trying to use Keynesian stimulus to get the economy going? Do you know offhand?
I don't have an exact number for that. That's actually that's a good question. I should know. Yeah, but I think
I'm sure that that's the minority, but still, I was wondering
Yeah.
if it's still noticeable. even
yeah. My
for the
impression is that
demographic.
the biggest contributor to the secular increase in deficits is just the pensions.
But that is the usual story told, is that they went on this big, trains to nowhere
Yeah,
fiscal
yeah.
expansion. So I'll be curious to see. Nope,
Because-
Social Security.
Yeah,
Because I calculated that 27% of the US debt is from all of the stimulus packages during the financial crisis and COVID plus accumulated interest.
I see. Right. So I suspect it's a bit smaller in Japan, but I should have a more precise answer. That's a good question. So what have they been doing? Let me sort of give you the bottom line and then provide some more detail just in case I don't get to it later on. What they've been doing, and this is what you notice when you consolidate the central government with the central bank, the Bank of Japan, and all the pension funds, et cetera, and you look at the consolidated balance sheet, is you realize they've been essentially running a risky carry trade. And by taking risks in various markets, currency markets, equity markets, bond markets, they're earning an additional 2 to 3% of GDP per annum on average. How do they do that? Well, first, there's risky maturity transformation to the tune of 1 GDP. How do they do that? Well, they borrow at floating rates through the Bank of Japan, which issues reserves. I'll come back to how that works, but that's what happens when the Bank of Japan buys back government bonds and issues reserves. You're borrowing at floating rates, and then they turn around and they invest mainly through the pension funds in risky assets, including longer maturity bonds abroad and stocks. And they're also in the process, as I said, investing half of Japanese GDP abroad and without hedging currency risk. So what does that mean? Well, they're doing a classic currency carry trade. Japan is, or the Japanese yen, is a funding currency. If you're a carry trader, suppose you're at a hedge fund and you're running a currency carry trade, what you would do is just that. You would borrow in yen and invest in US dollar or other foreign currencies. The Japanese government is doing just that to the tune of 1/2 of GDP. So if you add all of these different risk premia they're harvesting in different pockets of the market, if you add it all up, it adds up to 2 to 3% of GDP, which, by the way, that's a big deal. That's actually a large number. Now, of course, they're taking risk, right? This is not a free lunch. As a result of this, there's a huge duration mismatch on the government's balance sheet that I'll talk about. When rates go down, that's great news because that creates a lot of extra fiscal capacity for the Japanese public sector. Why is that? Well, because their liabilities are biased towards floating rate because of what the Bank of Japan's doing. They have a lot of assets that are longer duration. And so actually the weighted duration of their net liabilities is negative, actually. But its surpluses are very far in the distant future. So if rates were to go up dramatically, and it seems like that's starting to happen, that would be very bad news for the fiscal capacity.
That's a question.
Please.
Some years ago, there was something went on in Japan, and I read the Monetary Policy Committee, which they're all translated into English. Have you done a kind of search through all those things to see whether or not they say what you're talking about to each other?
That's a great question. So the language that is used amongst central bankers, and that applies to the Bank of Japan as well, rarely makes explicit references to fiscal challenges for obvious reasons. But I'll try to convince you that quantitative easing, the way it's been carried out in Japan, was largely an exercise in financial repression. It was just a way of the government to try and lower its cost of funding. And one little piece of evidence that I'll mention right now is, if you thought it was all about the zero lower bound, then the question is, why is the Bank of Japan still buying bonds today, even though inflation is actually running at 3%? They're pretty, they've solved the zero lower bound problem. They're a long ways away from it, but they're still buying bonds. That, of course, suggests that maybe what they're really doing was actually financial repression along the lines of what the Fed and the Treasury were doing in the Second World War, for example.
So I think my intuition would have been that the long duration liabilities, that part of it, rates go down, that gets more expensive. But you're saying that the duration of the assets is longer than the duration of liabilities.
Very long. It's because they've invested a lot through the pension funds in equities and in foreign equities. And I'll talk about the foreign part as well. That's important because you get a lot of duration from the currency risk. I'll show you that.
I think another thing that might be going on, I don't know how you measure or model the evolution of the liabilities, but my understanding is that their pension system has got a lot of macroeconomic indexation in it. It's got what in the German context we call sustainability factors, so that it does actually vary with macroeconomic conditions. But do you think of the Social Security system as just being like a fixed promise, or does it have all these bells and whistles?
I'm actually, for the purpose of what I'm going to talk about today, I'm not going to get into that much detail in terms of exactly how the pension system works. I'll just show you the evolution of deficits and then show you how the picture changes once you consolidate all the different constituents of the public sector, not just looking at the central government. And then you realize that what they're really doing is taking on a lot of risk. And then the question is, well, why does that work? Can you really run a sovereign wealth fund with borrowed money? And I think that's where you need financial repression, because if everything is priced accurately in financial markets, then that shouldn't really work because your cost of funding is going to go up. So I'll talk about that, but I'm not going to go into the nitty-gritty details of exactly how.
Because you're not going to. I'll just make one more comment, which is that it could then be that you're investing in equities isn't such as big a mismatch as you might think. It probably still is a mismatch relative to liabilities. The liabilities have macroeconomic indexation in them because those are also correlated then with market pricing factors. That was. Oh,
I see. That's where you're coming. I'll think about that. That's an interesting point.
We're
not talking about that.
So I'm actually curious about the political economy of how this came about, in the sense of, like, I understand that you may not know, but do you have a sense of,
yes, I think I do.
Who is affecting decision where, and to what extent the Japan central bank is?
Okay, yeah. So I'm going to get into that, but the short story is there was always financial repression. The government had access to cheap funding through, for example, the postal bank, which was the largest financial institution in the world. They were actually required to buy government bonds. And then in the 80s and 90s, they said, well, you have to liberalize. They liberalized. Remarkably, exactly when they fully liberalized, that's when the Bank of Japan started buying bonds. So they kind of replaced one cheap source of funding with another cheap source of funding. And I'll show you that the timing lines up nicely. So that is my understanding of what happened. Now, this is not a free lunch because you have to think about how this impacts Japanese households, obviously. And I'll try to convince you that especially for younger Japanese households who are mostly saving in deposits, the Japanese investor is like a German investor. They don't invest in stocks, they invest in deposits. They're stuck trying to accumulate wealth at negative real rates. And of course, that doesn't work. They have very little duration in their portfolio. So when rates go down, there's no capital gains for young Japanese households. And so for them, it's awfully hard to save for their retirement. So there are large welfare losses for young non-participants, which is a huge fraction of the Japanese population. And so the broader point here is it's not a free lunch. And in fact, if you think about it, it's a very regressive tax. It's a tax on less sophisticated, younger Japanese households.
The Bank of Japan increased the supply of reserves a lot. So I know Japanese people are sort of forced to hold bank accounts, but how do they hold so much more bank accounts? Who's holding all the increase in reserves that has to be increased deposits?
I'll show you some numbers, but the household sector holds, I think, roughly twice of GDP in deposits. So there's
that increased during the period?
Oh yeah, dramatically. I'll show you. Yeah, it went way up.
Wow.
Yes. Yes.
What convinced them to triple the amount that sits in bank accounts?
That-
Okay,
That's
on with the facts. Okay,
yes.
great.
I'll get back to that. Okay, so let's just start by looking at this the way we would typically do it, and this is sort of following the way George Hall and Tom Sargent think about the dynamics of the debt to output ratio. This is literally lifted out of their paper. The debt to output ratio today, you can write it as being determined by the past history of primary deficits, G minus T, the cost of funding of the government, R, and the growth rate, okay? And R, T minus J to T, that's literally the cumulative cost of funding. So it's just the product of the 1 year cost of funding. And so that equation gives you a rough sense of how to think about debt over output dynamics. And as you know, if you're in a steady state deterministic environment, so suppose that R and X, the growth rate and the cost of funding are constant, you're in a steady state environment where X is bigger than R, and I'm using X here again to denote the growth rate to avoid confusion with G, government spending. If you're in that region of the parameter space, and you of course subtract from risk, et cetera, then you might say, well, the government can just roll over debt in perpetuity and run steady state deficits. But if you look at actual returns on outstanding Japanese government bonds, you see that that's not the case for Japan. The number we end up with is something like 150 basis points. The growth rate is negligible. Inflation is also very small. But so we're definitely not in the region where the growth rate exceeds the government's cost of funding. So that's not it. We're not in that Goldilocks region. And so if you think about what's happened over the past 26 years between 1997 and 2023, that's the sample we'll look at, then you should have this number in mind. The average primary deficit was around 5% of GDP, 26 years. That is roughly 133% of GDP in cumulative deficits over this period. So clearly not a sustainable trajectory thereon. That's the picture you get when you just look at the central government. And that's what most people look at. What we're going to do, and that's really the main exercise here is just accounting, is we're going to say, well, actually, you should probably think about local governments, public pension funds, the BOJ, the Bank of Japan, the central bank, and publicly owned financial institutions, because presumably there is a common budget constraint that all of these institutions jointly face. And then we're going to analyze the budget constraint of the consolidated public sector. That's really the idea, and that's where the meat of the paper is. And this goes back to Paula's question. Once you do this, the first thing you realize is that what happened is prior to 2001, the Japanese government had access to cheap funding. because households were essentially trapped in low yielding deposits. There were interest rate ceilings on deposits. Most households had deposits at the postal bank. As I said, that was the largest financial institution in the world, and they were required to hold government bonds. Post 2001, they said, hang on, we're going to stop doing that. We're going to liberalize. But immediately, the Bank of Japan started large-scale asset purchases. Of course, when they did that, they were mainly talking about the zero lower bound. But essentially, if you look at it from a fiscal perspective, it sure looks like what they were doing is substituting one source of cheap funding with another one. Yes.
Is there free movement of capital out of the country at this time, or was it restricted in any way for households?
I'll talk about that, but if you were a Japanese household and you would have wanted to buy U.S. equities, that would have been costly and hard. Let me just put it that way.
Okay, so.
But I'll come back to that in a second. Yes, because you're probably thinking, wait a minute, why don't they invest
No,
abroad?
especially young people today, they should just be buying the S&P 500 and go to bed.
Yes, so
Doubles in 5 years.
that's certainly not what the Japanese, a
No,
typical
I know, I
Japanese
mean, it's
household
almost
are doing.
incomprehensible.
Yeah.
In the
Yeah.
liberalization, what were they allowed to buy instead of postal savings banks?
So if you wanted access to stocks, then you would have invested in these trusts that are essentially like mutual funds, but they're very poorly run and very expensive. And so you certainly would not earn the equity premium. You would earn the equity premium minus 200 basis points. And
The alternative source of cheap funding, so what went away?
yeah, so
So the households you're saying didn't have to just hold the deposits. I'm just curious what they were holding instead. Then the Bank of Japan jumped into.
They were holding deposits, but the postal office was not mandatory.
yeah,
forced
sorry,
to
I
buy
should be
bonds.
clear. The postal office was no longer required to invest in government
I
bonds.
said, we're just gonna go to banks instead of the postal office. Okay, got it.
Okay. So let's start before we actually do this consolidation by looking at the Bank of Japan's balance sheet. This is the Bank of Japan's balance sheet in 97, and everything is reported as a fraction of GDP to make it comparable across the different years. And as you can tell here, that's a pretty small balance sheet compared to the size of the economy. The picture below plots net purchases of Japanese government bonds for different sectors of the economy. I apologize, that's a bit small, but the key takeaway there is that the red lines are purchases by the Bank of Japan. And what you can sort of see is that around 2000, you see a massive increase in purchases by the Bank of Japan. The black line is issuance, and so that's not a mistake. The Bank of Japan was actually, for a decade or so, purchasing more than issuance on a yearly basis. And what you ended up with then is this balance sheet in 2021. That's, of course, a much larger balance sheet. If you look at the liabilities of the Bank of Japan, they now have roughly 1 GDP of reserves that they've issued, right? So this is, these are reserves that you could think of just as deposits of financial institutions held at the Bank of Japan. And on the asset side, what you see here are the bonds that they've purchased by issuing these reserves, the bonds they've bought back. And so essentially, the Bank of Japan now holds roughly half of the outstanding stock of Japanese government bonds.
What about foreign reserves? Were they, I don't see any foreign reserves anywhere in your.
That's in here as well. In the background, I'll show you that in a second.
Okay.
This is just the Bank of Japan, but when I consolidate, that's all going to be in there.
Okay.
So now, so here this will have all of that.
Oh,
in
yeah,
it.
okay, I see.
So
Foreign
now we're
securities.
actually looking at the entire public sector. I first just wanted to show you what's happening at the Bank of Japan, because that's kind of a key driver. And so what you see here, if you look at the liabilities side of the entire Japanese public sector, is that before, the Japanese public sector was funding itself partly through these cheap deposits that I mentioned earlier. That was largely replaced by bank reserves issued by the Bank of Japan to the tune of 1 GDP. If you look at the asset side, that is also important, of course. What you see here is that they have a domestic equity position of 31% of GDP, and then they invest half of GDP abroad without hedging the currency risk, importantly. So they're doing a currency carry trade. So these are really significant numbers, right? This is, think about it. So the equivalent for the US would be you're investing 15 trillion in foreign securities.
They
Yeah,
said this includes the pension funds, right?
it includes
So
all that.
What is the fiscal link between the government and the pension funds? How are they part of a consolidated balance sheet?
Well, this is broadly speaking an unfunded pay-as-you-go pension system. And so when there are shortfalls,
So on
Has-
top of the social security system, there's a pay-as-you-go pension system. And they are the ones who are buying who are,
yes, but part of the foreign reserves are also invested in foreign securities. Yes.
Wait,
So we're, yeah,
So the unfunded pension liabilities, a liability of the government?
yeah.
Okay. I mean, so those could be on the balance sheet, I suppose, right? I mean, if I were consolidating the balance sheets, okay, I'm putting the pension assets on there.
Oh, I see. Yes.
Actually, I should really have the total pension assets and the total pension liabilities on the balance sheet if I'm consolidating.
Oh, I see. Well, that's a bit harder because then I would have to actually make projections about the size of these unfunded liabilities. I didn't do that.
Well, you can make projections just of the size of the liabilities. You have
Yeah.
the present value of the liabilities, you have
Yeah.
the present value of the asset, the current
Right.
value of the assets. That's how I would consolidate a balance sheet with pension funds. It's like what we do with the US states, for example. It's like,
That's a good point. We could do that. We haven't done that. But I think, so bear with me, because for the purpose of the point I want to make today, I'm not sure that would be, well, it might be relevant, but it's not material, I think, to the point I want to make. But
these assets and liabilities don't add up, right? Because you got the bonds outstanding, but you don't have the present value of the payments and the taxes on the left-hand side.
well, I don't have to explain that to you, but yes,
Right, no.
if the Japanese public sector has a net liability, that has to be backed by future surpluses.
These
Yeah.
don't add up to 100%, so it's not a problem.
Oh, no.
that the pension funds
Yeah, yeah,
who
yeah.
don't have the pension.
Yes, no. So you're right. They don't, yes, they don't match exactly because they're future surpluses. Let me get to that in
And
a
future
second.
pension liabilities.
Yes, so, yeah. What I want to do first is go back to that first equation. But now I want to think about how the net debt evolves over time. So instead of just thinking about the debt of the central government, I want to think about the value of debt minus the value of the assets and think about how that evolves over time. And then you see there's a second component there, which is governed by the excess return the government earns over and above its funding costs, RD, on its risky investments, okay? And if that excess return is high, that's obviously, this is not rocket science, it's going to slow the growth of ND, of the net liabilities of the government, because you're harvesting these large excess returns on your investments. And in fact, if that's big enough, you could end up in sort of a Goldilocks situation where even though your cost of funding in a deterministic setting exceeds the growth rate, if that excess return is big enough, you might still be able to run steady state deficits. So let me show you how big these numbers are. So the first thing we could do is go back to where we started. I told you that the total increase in outstanding debt as a fraction of GDP, if you accumulate all the deficits, was around 133% just for the central government. If you now subtract the excess returns that the government earns on its assets, you have to get to 70%, because 70%, that's the increase in net liabilities, which is much smaller, okay? So we started with 133% of GDP. It's down to 70%. That means that you can back out an excess return as a fraction of GDP of 2.4% of GDP. That's sort of the implied excess return. I'll do the actual return calculation on the next slide, but that's the number you should keep in mind.
I'm still troubled by these pension funds. So pension funds they're taking premiums and they're investing them abroad. And that's it. The government is issuing bonds, but the government doesn't directly own those securities. The pension funds aren't issuing the loan. They're not leveraging. I mean, maybe if they make all this money, the government can tax them at some point, but it's not clear to me why we put private pension funds in a consolidated.
Oh, this is not private. This is public. Sorry, this is all public pension funds. This is government-run pension funds. There's no, oh, sorry, I should, yes, this is all public, right? There's no private pension funds anywhere here.
I see, and so to some extent, they're receiving premiums.
Yeah.
But they're also receiving government subsidies. Is that where it links with the taxes?
Yes, and certainly there's a backstop, right, in the background. So we're just saying, look, you know.
Yeah. But then the premiums should be included as part of taxes, right? Or are they in your account?
But these are largely pay-as-you-go systems. So they
are measured in your taxes because those are payroll taxes so you're saying the premiums are included in what you're calling tax. Good.
I'm not sure if it's entirely, there's like 3 different tiers in the pension system. I'm not sure exactly how it's split out, but basically these are unfunded pay-as-you-go systems. And we're just saying, look, there's a single budget constraint for the entire public sector. But yes, they're all public pensions. Sorry, I should have. Yeah, now I see where you were confused.
When you guys do this with Social Security in the US context, how do you think of that? Do you do like an accrued, do you in your other papers, do you consolidate Social Security with the rest, you do, right? The rest of the government budget. And so how do you do that? Because that's also an unfunded system.
Yeah.
And you know, my thought is, I mean, what you could do, what I understand some people is they say, okay, let's look at the accrued benefits. And then we have this, you know, trust fund, which kind of goes away when you consolidate it with the rest of the government budget. But
yeah,
then the accrued benefits then become a liability. Is that, are you doing that kind of, is it, well, yeah.
Well,
yeah.
we're looking at the total deficit. So that's all in there, right? That's going to be, it's going to show up in the dynamics of deficits. But
yeah, he's not trying to take a present value that has 100 and 100.
Yeah.
It's like there's this stuff that has to finance that flow.
Yeah, I'm just doing simple accounting here and trying to give you a sense of how important these excess returns are, and that they harvest by taking on risk, and they're very important. So to their first order, so because basically total debt increased by 133% if you just accumulate all these deficits, 5%, 26 years. But the net liability only went up by 70%. And so that means that they're harvesting around, if you believe this equation as a rough approximation, 2.4% of GDP. Now, what I want to do is actually measure the excess returns directly. And then what you get is a number that's pretty close, 2.28%. So that back of the envelope calculation is actually pretty darn close. That's the point I wanted to make. How do we get to 2.28% of GDP? Well, it turns out that the Japanese government earns an excess return of 190 basis points above its cost of funding on average. If you look at the last decade, when they really got to work in terms of quantitative easing, that number goes way up, by the way. So if you think, as I do, that quantitative easing lowers the government cost of funding substantially, you see that in that 4.66% number. The last column now expresses everything as a fraction of GDP. So it computes the total dollar or yen amount, excuse me, in this case, and then divides it by Japanese GDP. And so you end up with a number like 2.28%, pretty darn close to 2.4%. Okay, so again, over the last 10 years, that number was much higher. It was actually 6.25%. So over the past decade, from taking all this risk, the government harvested an additional 625 basis points as a fraction of GDP.
Do they publish their portfolio?
The pension fund tells you roughly what they're holding, and we
Okay,
use that.
what asset, but they don't tell you what assets, what
there-
stocks.
They're not Norwegians. They don't tell you exactly what they're holding, but they do tell you, broadly speaking, which asset classes they're
Okay.
invested in. Yeah, so I think this number is pretty
Like the
accurate.
Stanford Management Company.
Yes. So these are big numbers. How did that happen? Well, let's go back to the consolidated balance sheet and think about how has that changed over time. So between 1997 and 2023, again, everything is expressed as a fraction of GDP. What the Japanese public sector has done is invest an additional 28% of GDP in equities, an additional 1/2 of GDP in foreign securities. So again, these are large numbers. This goes back, by the way, to John's question. So obviously the sum of the assets is, let's say in 2023, 180%, but the sum of the liabilities is 275%. And so the difference, 94%, you could think about that as the present discounted value of
Do they
future
farm this out
surpluses.
to investment firms, or do they do it directly? Like
The,
Goldman and JP Morgan and other stuff on the foreign?
the main Japanese pension funds, I'm not sure whether they use external managers. But I could look into that. That's a
I'm
good
just
question. Yeah, I don't know, actually. I probably should know that, but I don't. But they have very specific targets for their allocations, and they do publish those. So that's what's going on now. On the liability side, we've talked about this before. What they did was basically they borrowed at the floating rate over the last decade by borrowing one GDP at the floating rate, which is the rate they pay on reserves, which actually throughout this period was essentially zero. So
So you're saying that their debt to GDP ratio is really only about 68%, not 250. That was your the bottom.
for the consolidated public sector, it's
Yeah.
much smaller. Yes,
So
that's correct.
The issue I have with that is, I think that when you include the fact that they've borrowed a bunch of money from employees through pension arrangements, that's a huge liability, and that's going to increase the liability back up. That's what I'm trying to get at with asking about the unfunded liability on the
Yeah.
total liabilities, not
Mhm.
unfunded, just the unfunded,
Yes.
total liabilities and the liability side of the balance sheet, because that's a source of borrow. That's the way you think about the pension.
Yeah, I'm trying, yes, I agree. I mean, if you wanted to quantify that, then I should definitely do that. The question I first wanted to address is a simpler one. People look at this and they think, how were they even able to do this without getting massive inflation, for example? And I'm saying, well, actually, if you add it all up, their deficits are smaller than they appear because they harvest these large excess returns from their risky investments. But again, I'm not saying that that's a good idea, right?
Yeah.
That's where I'm going
So,
next.
my
Oh.
question is then, so the returns
Yeah,
from these invested assets
Yeah.
doesn't go to the pensioner. It's just the way, like, I'm trying to figure out, you could imagine if
Yeah.
I'm running this
yeah,
as a private pension fund, you have the allocation, and then the allocation will go to, this is a pay-as-you-go system.
yes,
And it's a defined benefit, right? So in some way, they're doing like an insurance company. And actually in Italy, they did exactly,
Yeah.
there was financial repression, but it was done to insurance companies, in which the insurance company were mandated
To hold
by
it.
the government to hold government bonds.
yes.
So in some way that was and then the question is, the returns, so basically there's a redistribution of returns
There's a lot of
in the back of these.
Yes, yes, absolutely.
Another way to put it is, the pension system, rather than ours, which buys government bonds, theirs bought foreign stocks. They made a killing on the foreign stocks. Those can finance a large proportion of the pension payments. And so only 60% of GDP is left over to be financed.
Yes, but this financial engineering wouldn't work without financial repression. That's what
I don't agree with that because the unfunded liability, he added the assets to the balance sheet, but not the liabilities to the balance sheet.
Those are constant. Those didn't rise.
The liabilities are constant? I don't think that's true.
We're going back to the last slide here. When the stock market went up,
Yep.
the pension funds made a killing. Their liabilities didn't change.
Oh, their liabilities absolutely did go up by a lot because interest rates came down by a lot. So the market value of their liabilities went up by a lot. Maybe they didn't mark it on the balance sheet, but they absolutely went up tremendously in value.
Yeah, I'm going to think about that because I think that's an important point. But just to summarize, what they've done is they've taken a lot of risk in equity markets and in currency markets. So they've invested half of GDP in foreign securities. That, by the way, makes them essentially the largest currency carry trader in the world because what they're doing is they're borrowing in yen, a low rate funding currency. In fact, when you explain the currency carry trade, that's typically the example you give. And they turn around and invest abroad in higher interest rate currencies. Okay. Now, let me do a few counterfactuals, and this will set us up for our discussion of financial repression. Suppose that there had been no QE. Japanese sources estimate that the effect of QE was really large, that lowered yields by roughly 200 basis points cumulatively after 2012. Suppose we actually run that counterfactual. So suppose that the returns on Japanese government bonds would have been 2% higher than the actual returns. What would be the effect on these excess returns? Well, it's pretty dramatic, as you can see from the bottom panel. So that's the no QE counterfactual. And in the last column, you see that now the average return as a fraction of GDP goes down from 228 basis points to 66 basis points. What if they were actually forced to hedge the currency risk, which, by the way, if you're a Japanese financial institution investing abroad, you're sort of forced to at least hedge part of the currency risk. You can't just leave all that dollar exposure unhedged. If you were to force the Japanese public sector to hedge the currency risk, that also dramatically lowers these returns. And if you combine all of it, then the entire excess return is gone. So to understand why they're able to do this, you have to think about QE and the fact that they're taking on a lot of currency risk and doing a carry trade. If you take that off the table, then the magic is gone. Okay.
Excuse me.
There's a question, I think.
Yes, please. Bob McCauley here. I wonder whether the long foreign currency position can be regarded as a hedge rather than an outright risk. The Japanese government bears both the earthquake risk and the international security risk, and either one of those could involve substantial imports upon realization. Indeed, the latter risk, security risk, they're already stepping up their defense spending, much of which will go for foreign weaponry.
Thank you. That's an interesting point. Honestly, I hadn't considered. You're saying this could be the Japanese public sector hedging some dollar exposure that it already has. I'll think some more about that. But for the purposes of today, all I want to do is point out that this foreign currency exposure is a big source of the excess returns. That and quantitative easing combined account for pretty much the entire excess return.
Following up on that thought,
Yes.
The yen is at a very weak level historically in real terms. So it's interesting to consider what mean reversion might imply.
Yes, so I'll get to that. This is another footprint of financial repression over the past. So 25 years, between 97 and 2023, the real exchange rate has depreciated by roughly 50%. Why does that happen? Well, if you artificially lower the real rate of return on your investments at home, that is sort of what almost any model of exchange rates will tell you has to happen. Your currency has to depreciate, and that's happened in a big way. That's another cost of financial repression, if you think that's what's going on. What is financial repression? It's just different ways the government uses to lower its cost of funding. This is something that even the US has done on occasion. If you look at the Civil War, the First World War, the Second World War, and arguably maybe even COVID, although that might be more controversial, there's some work by George Hall and Tom Sargent that argues that that is the right way of thinking about what happened there, even though they don't necessarily use the word financial repression. I think they certainly suggest that what happened during these big wars and what happened during COVID was similar, and part of the government's attempt to lower its cost of funding. I've already sort of given you a little bit of the institutional detail. Let me actually then get to what I think is a key question. Is the debt priced correctly? So why is that an important question? Well, ultimately, you'd want to know, can you really do that? Run a sovereign wealth fund with borrowed money while keeping the debt risk-free? And I think the answer there is, well, no. On the asset side here, you have, and this is what John was sort of complaining about that I missed on the earlier balance sheet. You want to have a claim to government surpluses, right? And then you have, of course, your financial assets, all the equities you bought, loans you've invested in, foreign assets. That's your asset side. What do you have on the liability side? Well, that's what I just showed you. Mostly reserves and government bonds. Okay. All right, now basic finance, no arbitrage. This sort of probably reminds you of Miller Modigliani for a company, right? If you look at a corporation's balance sheet, sort of says, well, the expected excess return on the right-hand side has to equal the weighted excess return of the surplus claim and the risky investments. That's just standard no arbitrage. The ratio of risky assets to debt is roughly 66%. And so what you then can wonder is, well, if we sort of do the math, what do we get? And I think what you learn really quickly is that debt is probably overpriced if you do the numbers. And here's why. So plug in that 0.66 number for A over D. What do we know? Well, we know that the realized return, excess return on risky assets was roughly 190 basis points. And so if you rearrange that equation, you end up with an equation for the spread between the return on your risky investments, RA, and the return on that surplus claim. What is that surplus claim? Well, that's what's in the top left-hand corner over there, right? That's a key part of the balance sheet. Yes?
So I got to object because there isn't arbitrage. And another way of saying it is, if the government has, if you on the left side of the Laffer curve, it's certainly possible that fiscal surpluses will always make up the difference. In fact, it's almost an accounting identity that they, so it will make up the difference if you include the inflation tax.
Sorry, that's not where I'm going. I'm just talking about, so I'm making a slightly different, I agree with you. That's not where I'm going to say. I'm going to argue that what this implied is that the excess return on the surplus claim has to be deeply negative. Has to be so it has to be a very negative beta security. If I were to secure it, all right? Yes, but that's hardly in line with the data.
Well, it is possible.
Surpluses are not strongly.
Well, if they do not default it or inflate it away, then they will have to raise taxes or cut spending.
Yeah.
And then, it's going to happen.
Yes.
You're just saying they're likely to inflate it away.
If you look at a picture of surpluses, so here's what John and I are talking about. So
not to date. But they, when the crisis comes, they
Yes,
have to
every-
raise taxes.
Yes, it's actually very hard to find examples of fiscal crises where all of a sudden you sort of see a radical switch in the cyclical properties of these
Delayed.
surpluses.
Well, a crisis isn't cyclical. A crisis goes boom.
Yeah,
So
this is about
delayed.
this is about the risk properties of. So suppose we were to trade a claim to surpluses. What this math says is it has to be a very safe claim, which means that you would run huge surpluses in recessions.
No,
That's not what the Japanese government does.
You're mistaking the current surplus and the present value surpluses.
No.
In recessions, we always lower current surpluses, but raise the expected future ones.
What you're saying is, well, this stock looks risky, but actually, going forward, actually, it could be completely countercyclical, negative beta. That doesn't seem like a compelling argument. Yes, it could happen, but it doesn't seem very likely. And I cannot think of a single example of an advanced economy where governments do that. Governments don't run large surpluses in recessions, and this is what that says. That's all.
You're mistaking the surplus and the present value of the surplus.
No, John, I think
Surplus itself goes down in recessions, but the present value is unaffected because they borrow now and they pay it back later. But
this is about the risk properties of the surpluses.
which is about the total rate of return.
I
Which includes
understand.
the current payment and the present value of the future. So the current deficit can
Yes.
go
But that's-
very happy with a rise in the present value of future ones.
But
because
that's
they're gonna pay it off. That's the way bonds always work.
Ultimately, that's all governed by the properties of the cash flows.
Right, which you are assuming are an AR1 and they're not.
No, I'm not making it. Look, this is what it is. That's just the math. You could say, John is saying, I think that's entirely reasonable.
I think
I,
it's possible.
okay, yeah,
No, I think
I
there's-
certainly wouldn't want to argue that. If you were to say, okay, if you were to come to me, you're at Goldman and you told me, Hanno, do you want to buy an ETF? That's a claim to Japanese government surpluses. And you're going to tell me the expected excess return is minus 2.96%. I think I would pass. That's all. Anyway, let me skip this. This is, I think, so if you do the math, you get to a wedge of 180 basis points. So this is saying the yield on the debt is too low by roughly 182 basis points, which is in line with the estimates that I've read of the effect of quantitative easing. Where does that show up? So some sort of other evidence is, and I think this was mentioned earlier in a question, in the currency market. So over the past 27 years, the real exchange rate has appreciated by 45% or 1.68% per annum, okay? And so another way to get at this, sorry, Ryan, you had a question.
I'll
Yes.
wait until you're.
Another way to get at this is to say, well, to make sense of what's happening to the exchange rate, we could think about something like long-run UIP. Long-run UIP says, well, if you take a 30-year US bond and a 30-year Japanese bond, let's make it real, and you compare the yields, then that tells you what the expected rate of depreciation of the yen in real terms is against the dollar. So looking at the long end of the yield curve, okay?
Can I ask, just
Yes.
like backing up a little?
Yeah.
Does this, you're saying this is a carry trade, which I think is right, and those obviously have they take the stairs up and elevators down.
Yeah.
Just like, what is your view of this strategy broadly? Because 2 to 3% of GDP is definitely a very large amount. Obviously, there's costs, and you're going to talk about,
Yeah.
to younger households, but it doesn't, they're able to do this consistently over the course of 2 decades pretty well and earn a lot of
I think the wheels are coming off this experiment in the sense that they're pretty far away from the zero lower bound now. Inflation is running at 3%. And so it looks like what's going to have to happen is that the entire yield curve will be pushed up. Now, given the duration mismatch that's built into this exercise, that means that would destroy fiscal capacity dramatically for the public sector. So that would be what ends this experiment.
Yeah.
So that's the sense in which they could get into trouble. But as Paula said, this also has very unappealing cross-sectional implications. So let me actually, I think I'm almost out of time, so let me briefly go there. But basically, from long-run UIP, you would infer a wedge of roughly the same ballpark, okay? So here's the exercise. You would say, well, wait a minute. In order for this 45% real depreciation not to happen, how much higher would long-term real yields have to be in Japan? And you get a number around 180 basis points. So that looks like a plausible number. That's the point that I want to make, some independent evidence.
So your colleagues at GSB might say that this isn't financial repression, it's just the wonderful liquidity value of government bonds?
Yes.
I didn't mean to sound.
One person's convenience yields to another person looks like financial repression. I don't think that those Japanese depositors are super enthused with all the liquidity and safety they're getting, but it could be true, and it's hard to refute that, right?
Also, now that huge depreciation of the yen,
So
that's a lot of inflation built up when they catch up to international prices, right?
yes, and that's actually, I think, some of the most compelling evidence that this is really, it's all about distorting long-term real rates. This sort of huge, massive real depreciation, I think, is
Because stuff is really cheap in Japan, and when they
Yes.
start paying our prices,
Yeah.
so in that sense, that's a built-in inflation as we finally get back to PPP, right?
yes.
What's the longest dated dollar yen futures market? How far out can you buy? I was just looking here, it says like a year. I don't see anything longer.
Okay, so
You won't live that long, Alvin.
so
You won't live that.
certainly 5 years. In fact, I'll show you some. So real quickly, and I think this also came up. Maybe it was your question or your question. I forgot. Why don't Japanese banks or intermediaries invest abroad? It's hard for individuals to do this. Well, they have to hedge the currency risk, and maybe not all of it, but certainly a significant chunk of it. Otherwise, regulators would be on their case if they end up with trillions of dollars in dollar exposure. What's the result of that? Well, because of all the hedging pressure, because there are all these Japanese investors who are trying to do just that, covered interest rate parity breaks down, and you have very negative basis, which acts, the way you can think about it is it's a tax on foreign investment if you're hedging. And these taxes are significant, actually. So on average, they're between 50 and 100 basis points. So in terms of maturities, this is 1 month, 3 months, 6 months, 1 year. Sorry, the axes here are very small, I apologize. This is for longer maturities. So here we're going out to, Chris, can you tell what the longest maturity is on there on the bottom? I can't see from here.
30 years.
30 years. So you can go out pretty far. Yes. So huge negative basis everywhere. What does that mean? Well, there are all these intermediaries. They're intermediating 3 GDP in deposits, insurance, pensions. They want to invest abroad, but they can't all do it at the same time if they want to hedge, because then that creates this negative basis, which is like a tax. If you're the government, you look at this and you might think, well, there are ways I can fix this by changing financial regulation, but it's not clear you want to, because this helps you trap
They're all
Japanese.
criminals. The government is a criminal organization, basically.
Well, I'm not going to go that far, but certainly this is not in the interest
Of the public.
No, it is not. I
Okay,
think
well,
that's
that
correct.
makes it,
Yes.
all right.
So if you're thinking, how do they get away with this? That's part of the answer, is that they have these CIP deviations that actually work in their favor, and actually make this somewhat more sustainable. Okay.
They're also earning the equity premium.
Yes, but still, you're giving up between 50 or 100 basis points, and if these flows would be much bigger, presumably that basis would go up, right? It's
So why don't, our hedge funds have been doing this for a long time, borrowing yen, investing in dollars, and
Well, I think, right. So the way to think about this is the Japanese government does the carry trade, but they don't let the private sector do it.
in Japan.
In Japan, correct.
But the private Goldman Sachs can do it.
Yes. But are you referring to the carry trade now or to the CIP deviation? Sorry. or both.
Both. Well, the
Okay.
carry trade doesn't need hedging.
Yeah.
Okay, go ahead.
Yeah, the carry
Sorry.
trade is, so, but the key point is, the government doesn't hedge, the private intermediaries hedge, and then they pay a tax because.
That's
yeah,
almost,
you-
you were talking about repression. So your
Yeah.
risk regulation says you guys got to hedge.
Yes, that's the repression part, I think. All right, so I'm almost done here. The last point I want to make is, well, actually, if you look at their net liabilities, and this is a little counterintuitive, the duration of the risky assets is quite long because they have all this equity. Not trivial to measure duration of equity, but it's a large number. It's roughly the price dividend ratio. That's roughly how you measure it. And so if you add it all up, the duration of the risky assets is around 29, 30 years, but duration of the liability is much smaller. And so even though they have way more liabilities than assets, the asset duration component dominates, basically. And so they end up with a negative duration number. What does that mean? Well, it means, well, if the duration of your liabilities is smaller than the duration of your surpluses, and the surpluses are way out in the distant future, then if you lower real rates, then yes, that creates extra fiscal capacity. Of course, conversely, if you increase real rates, then you're destroying fiscal capacity. Why do lower real rates increase fiscal capacity? Well, you know the government's going to be borrowing for a long time until they start generating surpluses, and so they're now borrowing at a lower rate for a longer time. So that's what's going on the government side. By the way, if the government wanted to be perfectly hedged against interest rate risk, hedging came up earlier for the government, then what you'd have to do is match the duration of your liabilities to the duration of surpluses, right? So that would mean you would borrow at very long terms. That's not what they do.
I would think there'd be huge pressure on the Bank of Japan to hold interest rates down, especially long-term rates. Just this is sort of the new symphony of the world is,
Yes.
we want low interest costs on the debt and we'll see when the inflation crops up.
Yes, and central banks have invoked all sorts of plumbing problems that have appeared recently all around the world to explain why they cannot possibly shrink their balance sheets. Yes, yes. So I'm sympathetic to that view, so I'm not going to argue with you.
Well, the interesting open question is how long does it take to get the inflation, which we don't really know.
Well,
We'll find out.
Yeah, but Japan now has 3% inflation.
Yeah.
It's,
So do
I
we.
think, roughly at par with the US. And they're still buying bonds.
And hold the
So-
rates down.
So we talked about Japanese households being trapped in deposits. John, I think this was your question.
Yeah,
So now here you see a juxtaposition of Japan and the US. So it's quite dramatic, right? So Japan, the ratio of deposits and currency to GDP is now 190%. In 2021, it was actually 2. That's the number I gave you earlier. And so much higher than the US, and obviously a dramatic increase between 97 and 2023, right? So households do seem trapped in deposits, and I don't think it's because they're happily enjoying the safety and liquidity of deposits necessarily. It might just be a lack of viable alternatives, a lack of financial sophistication, all these sorts of things that we usually don't think
Hanno,
about.
Would it make sense to think, I mean, we had this conversation with John the other day, but would it make sense that to some extent there is a, of course there are distributional effect of this, but the Japanese households are partially funding this operation, unwillingly maybe.
Yes.
Versus the American one, they're not. So in some way, it's more fragile when you actually are opened. It's almost like a closed economy in terms of investing abroad, right? And so in some way, they can carry this game for a longer time. I'm not justifying it, but to some extent, it makes it less volatile.
I agree. In fact, I think it'd be very hard for the US to engineer a similar type of financial repression. And I mean, the first line already shows you it's going to be hard, right? Americans are not as enamored with deposits as Japanese
Some of
or
that is-
German investors.
Because equities have to include 401ks, right? So we have equity investments in our pensions,
Yeah.
which we're allowed to do. And it sounds like they don't. They have to find if you don't have defined benefit pensions,
Yeah.
yeah.
And actually, if you look at participation rates, what you can see is, yes, Japanese households have deposits. There, I think maybe the participation rate is even higher than for Americans, I think.
There
But
also
once you-
saving rates are much higher.
Are very high.
Much
Yes.
higher.
Yes, but if you look at securities, then you realize that participation rates, certainly in the lowest income deciles, quintiles, excuse me, are very low, right? Yeah, they're super low. Basically, most Japanese households are not participating in any asset markets. Yeah.
If you update the flow of funds stuff to 2025 with the latest data that comes up pretty often, it's gonna look, the difference between the US and Japan is gonna look even bigger.
Yeah.
I mean, just there was that recent post that I think you saw where US household wealth is now eight times average income,
Yes.
And a lot of that has to do, I mean, this thing correlates with this high beta, that number.
So if you think about, this is the last thing I want to mention. If you think about the sort of cross-sectional implications, then let's take just to fix ideas, let's take a young Japanese household that is mainly invested in deposits. So they have no duration on the asset side, but they have to save to finance their consumption after retirement to the extent they can't fully depend on the government program. Well, when rates go down, they don't get a capital gain because they have no duration. And so now they're saving at much lower rates going forward. So they're worse off. And in that sense, financial regression you can think of as a regressive tax. You can actually quantify this. And the way you quantify it is, and this is similar to what we did for the government balance sheet, you think of a household's financial wealth. Let's leave housing aside for a second. Just as a present discount value of its consumption minus its income, you can come up with a duration number for financial wealth. Obviously, if you have only deposits, then that duration number is close to zero. On the right-hand side, that is determined by the profile of consumption relative to income. But the point is, for a young household, the duration of consumption minus income is going to be pretty high. And then when rates decline, if you don't have a lot of duration in your financial portfolio, but your excess consumption relative to income is pretty far out in the future, then when rates go down, you're in case B and your consumption possibility set shrinks. You're not going to be able, in other words, to afford the same amount of consumption. You're going to have to cut back when real rates go down. On the other hand, if you're a financially sophisticated household and you have a lot of stocks and bonds, let me actually show that here. That's case A. Then you have a lot of duration in your portfolio, and then you're more than hedged. And then when rates go down, your capital gains are more than enough for you to be able to finance the same consumption stream as before.
Are capital gains taxes lower than ordinary income?
That is a good question. I'm gonna have to look into that. I don't know. That's a good question. That is relevant here, yes. So basically, if you're a young Japanese household and rates go down, you're sort of worse off, especially if you're saving in deposits. If you're an older, more sophisticated household, you're better off because the capital gains are more than enough for you to keep financing the same consumption stream. And so if you compute welfare costs of a 1% decline in interest rates, you actually get pretty big welfare costs for non-participants. And again, this is all governed by the difference between the duration of the consumption you need to finance and the duration of your portfolio. If that gap is zero, then there are no welfare implications. That's basically the bottom line, is that, and this is what I was saying before, that financial repression is sort of like a regressive tax, because as you're lowering rates below what they would be, younger households are going to have to cut back on consumption, especially if they're saving in deposits and they're less financially sophisticated. I'm almost out of time, so let me actually conclude here by sort of giving you maybe a couple of big picture remarks. The traditional macro view, and I'm painting with a broad brush here, when it comes to quantitative easing and real rates, is that advanced economies are experiencing demographic transition, secular stagnation. All these forces lead to lower equilibrium long-run real rates. That creates extra fiscal capacity potentially. And as economies bump into the zero lower bound, central banks deploy large-scale asset purchases. I want to present an alternative view, which is, yes, advanced economies are experiencing demographic transition, secular stagnation, but these forces directly lead to large government deficits. And that is why governments resort to low rate policies in order to be able to keep the fiscal ship afloat. And central banks might help by deploying large scale asset purchases. These two views are potentially complementary, right? It's not like there is one right view, but I think this one certainly has some merits, especially when you look at economies like Japan. This view has very different implications when you think about welfare and the heterogeneity of financial sophistication, duration in household portfolios. I think is an important topic that we need a lot more work on. When you lower real rates, you're raising the prices of all financial assets and other assets with a lot of duration, like housing, and that has important cross-sectional implications that are typically ignored when we think about these policies. Let me conclude. Thanks for all your comments, by the way. Let me conclude. What we did basically is just an accounting exercise. We consolidated the Japanese government's balance sheet. We tried to argue that the Japanese government has been engaged in risky maturity transformation, cum financial repression, and that they're running a very large currency carry trade. Again, with financial repression, keeping the government's cost of funding low. I think it's artificially low, but we can debate that. Is that a good thing? Well, it depends on which way rates go. If rates go up, the maturity mismatch on the government's balance sheet would mean that fiscal capacity gets eroded very quickly. This also has important implications for welfare because it all depends on whether you have duration in your portfolio, I think. So that's broadly what I have.
Not a reliable picture of a defense partner.
Not
Where are they going to get the extra money to raise and share?
I already made that point to John.
We're not in
All
a
right.
lot better shape.
Yeah. All right, thanks so much, Hanno.
Thank you.